The year 1929 marked a pivotal turning point in global economic history when the illusion of unending prosperity gave way to widespread hardship. The stock market, once a symbol of boundless opportunity, unraveled rapidly, erasing vast sums of wealth and triggering a chain reaction that affected ordinary lives far beyond the trading floors. This event, often remembered as the Wall Street crash, exposed fundamental weaknesses in the financial system that had been building for years. Rather than viewing it as an isolated catastrophe, understanding its roots reveals ongoing patterns in how economies function, influencing everything from personal finances to international relations, even in the present day. To grasp the full scope, consider the broader historical context of the 1920s. Following the devastation of World War I, many nations experienced a surge in industrial output and technological advancements. In the United States, innovations in manufacturing, such as assembly lines for automobiles and widespread electrification, fueled a sense of optimism. However, this growth was unevenly distributed. While urban centers thrived, rural areas struggled with falling agricultural prices due to overproduction and international competition. People from various walks of life, factory workers, school teachers, and small business owners, began participating in the stock market, often using borrowed funds to amplify their investments. This practice, known as buying on margin, allowed individuals to control large positions with minimal upfront capital, but it amplified risks exponentially. As speculation intensified, asset prices detached from underlying economic realities. Real estate values skyrocketed in cities like New York and Chicago, driven by loose lending standards from banks eager to expand their portfolios. Corporations reported inflated earnings to attract investors, while consumers embraced installment buying for goods like refrigerators and radios, extending their financial commitments into the future. This era of apparent abundance masked growing disparities. A concentration of wealth among industrial magnates and financiers left the majority reliant on credit to maintain their lifestyles. The Federal Reserve's policies of low interest rates encouraged this borrowing spree, aiming to sustain post-war recovery, but they inadvertently sowed the seeds for instability. When the market downturn began in late October 1929, it cascaded into a full-scale panic. Investors, facing margin calls from lenders demanding repayment, sold off holdings en masse, driving prices lower in a vicious cycle. Billions in market value evaporated, not just in stocks but across interconnected sectors. Factories idled as demand plummeted, leading to layoffs that rippled through communities. Human stories from this period illustrate the toll. A Detroit auto worker, having invested his savings in company shares, found himself unemployed and homeless. A Kansas farmer, already burdened by low crop prices, lost access to credit needed for the next planting season. These personal devastations compounded into a national crisis, with bank runs forcing thousands of institutions to close their doors, wiping out depositors' life savings. Yet the crash itself was merely the visible fracture in a deeper structural malaise. Excessive leverage throughout the economy meant that small shocks could trigger widespread failures. Income inequality had reached extremes, with the wealthiest 1% capturing a disproportionate share of national income, leaving little buffer for the working classes when conditions worsened. Moreover, the global financial linkages forged during the war era amplified the fallout. European countries, still repaying wartime debts to the U.S., faced capital outflows as American investors pulled back, exacerbating their own economic woes. In Germany, for instance, the ensuing hyperinflation and unemployment created fertile ground for political upheaval, contributing to the rise of authoritarian regimes in the 1930s. Examining cause and effect, the Depression's prolongation stemmed from policy responses that often aggravated the problems. Governments, adhering to orthodox economic thinking, pursued austerity measures, slashing public spending and raising trade barriers through tariffs like the Smoot-Hawley Act of 1930. These actions contracted global trade by over 60%, deepening deflationary pressures where falling prices discouraged spending and investment. Deflation made debts more burdensome in real terms, as borrowers repaid loans with money that had increased in value. Unemployment soared to 25% in the U.S., leading to shantytowns dubbed Hoovervilles after President Herbert Hoover, whose initial reluctance to intervene symbolized a faith in market self-correction that proved misguided. From a long-term perspective, the Great Depression prompted profound shifts in economic governance. The New Deal initiatives under President Franklin D. Roosevelt in the 1930s introduced regulatory frameworks such as the Glass-Steagall Act separating commercial and investment banking, and established social programs like Social Security to provide a safety net. These reforms aimed to redistribute risk and foster stability, reflecting a recognition that unchecked capitalism could lead to societal breakdown. Internationally, the Bretton Woods Agreement in 1944 created institutions like the International Monetary Fund to promote cooperative economic policies, laying the groundwork for post-war prosperity. However, these changes also embedded new vulnerabilities. Greater government involvement in markets normalized interventions that could distort incentives over time. Drawing parallels to contemporary conditions requires careful analysis of recurring dynamics. In the early 21st century, global debt levels have ballooned, surpassing 300% of world GDP by the mid-2020s. This accumulation echoes the 1920s, where borrowing outpaced productive capacity. Modern households grapple with mounting obligations from student loans, credit cards, and mortgages, often to afford essentials amid stagnant real wages. Corporations, too, leverage low-interest environments to fund share buybacks and expansions, prioritizing short-term gains over long-term resilience. Central banks, facing inflationary pressures, navigate a delicate balance, raising rates risks, triggering recessions, while keeping them low fuels asset bubbles. Inequality remains a persistent thread, with the top echelons controlling a larger portion of wealth than at any point since the pre-Depression era. This disparity arises from factors like globalization, which shifts manufacturing jobs overseas, and technological automation that displaces routine labor. The human element is evident in stories of young professionals in cities like San Francisco or London, burdened by housing costs that consume half their income, or retirees whose pensions erode under inflation. Such pressures foster reliance on debt, creating a fragile equilibrium where consumer spending drives growth but rests on borrowed foundations. Speculative fervor has evolved but not diminished. In the 1920s, crowds fixated on stock tickers. Today, digital platforms enable retail investors to chase trends in cryptocurrencies, non-fungible tokens, or volatile equities fueled by social media hype. Psychological drivers like fear of missing out propel these behaviors, much as they did nearly a century ago. When valuations exceed fundamentals, companies with persistent losses commanding premium prices, the risk of correction looms. Historical precedents suggest that such overextensions lead to abrupt reversals, as seen in the 2008 financial crisis, where subprime mortgage derivatives unraveled global credit markets. The interconnectedness of today's world economy heightens these dangers. A disruption in one region, such as a banking failure in the U.S. or a debt default in an emerging market, can propagate swiftly through supply chains and financial networks. The 2023 collapse of Silicon Valley Bank demonstrated this, as fears of contagion prompted rapid regulatory responses to prevent broader runs. Long-term, this globalization means economic policies in major powers like the U.S. or China influence distant populations. A Federal Reserve rate hike can strengthen the dollar, making imports costlier for developing nations and stoking local inflation. Policy dilemmas mirror those of the past. Central banks employ quantitative easing, purchasing assets to inject liquidity, echoing the 1930s efforts to combat deflation. Yet, this approach risks moral hazard, where entities take excessive risks expecting bailouts. Over decades, it has shifted wealth toward asset holders, widening gaps and eroding trust in institutions. Political responses to economic strain often veer toward protectionism or populism, as seen in rising trade tensions and debates over immigration, reminiscent of the 1930s backlash against free trade. Adding human dimensions deepens the narrative. Consider a family in rural India today, where rising food prices strain budgets already stretched by pandemic-era job losses, or an American veteran relying on fixed income amid escalating healthcare costs. These experiences underscore how abstract economic forces manifest in daily struggles, fostering disillusionment that can fuel social movements or electoral shifts. Looking ahead with a long-term lens, the echoes of 1929 urge proactive reforms, emphasizing sustainable debt levels, investing in education and infrastructure to boost productivity, and addressing inequality through progressive taxation could mitigate risks. Historical resilience shows that crises spur innovation.